The high-stakes drama of Adani. 2 years ago, the Adani Group was at the center of one of the biggest corporate storms in recent Indian history. The Hindenburg research report accused the conglomerate of fraud and financial opacity, triggering a plunge of over $150 billion in market value and shattering investor confidence worldwide. The drama sent shockwaves through markets, shares crashed, rating agencies downgraded debt, and questions about the group's vast debt and expanded empire dominated headlines. But today, as we step into FY25, the story looks different. Adani has slashed debt, posted record profits, and operationalized some of India's most ambitious infrastructure projects, including the strategically crucial Vizhinjam deep-water port in Kerala, now steering global shipping corridors. Is this a real comeback built on firm foundations, or a high-wire act precariously balanced on borrowed time and financial tricks? In the next 20 minutes, we break down the drama, the numbers, and the future outlook of India's largest infrastructure conglomerate. Chapter 1: Debt in the Spotlight, from Crisis to Control. Debt was and remains the elephant in the room when discussing Adani. The FY23 crisis sharply exposed the group's heavy leverage, with gross debt peaking near Rs 2.5 lakh crore. Interest costs were devouring cash flows with alarming ratios that spooked investors. But FY25 paints a different picture. Debt has been cut by Rs 40,000 crore, while EBITDA surged by nearly 20%, reaching close to Rs 90,000 crore. The debt to EBITDA ratio now sits at a healthier 2.6x, down from 3.5x just 2 years earlier, and a striking drop from near 3.8x in FY19. Yet debt levels remain substantial in absolute terms, around Rs 2.1 lakh crore consolidated, and much of it tied up in infrastructure assets like ports, airports, power, and renewables. Why is this important? Because the quality and predictability of cash flows back this debt, unlike many corporate giants or commodity companies that rely on market cycles. Over 80% of Adani's EBITDA in FY25 comes from annuity businesses, assets that deliver contracted, multi-year, and regulated cash flows rather than volatile commodity or trading profits. Examples: Adani Green Energy earns power revenue under binding power purchase agreements (PPAs) guaranteeing income. Adani Ports operates on long-term port service contracts insulated from commodity price shocks. Transmission and gas distribution assets generate revenue from regulated tariffs and approved pricing models. This business mix means debt service can rely on steady, recurring cash flow, reducing refinancing risk despite headline leverage. There are still risk factors. About $2.5 billion of dollar bonds mature by 2027, requiring refinancing amid rising interest rates globally. Interest payments consume nearly 17% of EBITDA, notably higher than Indian conglomerates like Reliance, which keep that figure near 10%. But with a cash pile of over 53,000 crore, enough to cover almost 21 months of debt servicing, and continued deleveraging discipline, the group walks a fine but more sustainable line. We asked a credit analyst for perspective. Adani's debt is large but manageable given the annuity nature of its cash flows and operational scale. The margin for error is thin, but it is not reckless risk yet. Chapter 2: Cement and Construction, Industry Headwinds and Adani's Long Play. Adani's big bet on cement through the acquisition of Ambuja Cement and ACC for $10.5 billion in 2022 has been under intense scrutiny. On paper, the price, around $230 per ton of capacity, was a steep premium compared to industry averages of $120 to $150. The FY25 results so far reflect a long haul, not a quick win. Ambuja/ACC delivered a return on capital employed of about 12%, trailing large rival Ultratech's 18%. Cost synergy targets of Rs 1,500 crore annually are approaching reality, with Rs 1,200 crore realized mostly through logistics support via Adani Ports. Energy costs, an Achilles heel for Cement makers remain about 15% higher than Ultratech's, although progress is visible in plant upgrades and coal sourcing. The kicker, it wasn't just Adani's cement segment facing profit pressure. The entire Indian cement industry saw muted profit growth or degrowth in FY25 despite steady volume increases. Reasons include declining realizations / pricing pressure, with prices down 7 to 10% year over year, rising input costs and interest expenses limiting margin recovery, delayed infrastructure projects reducing demand in key segments temporarily. Adani's cement ambitions are aligned with the 5 to 7 year growth horizon, banking on India's government spending on infrastructure and affordable housing to rebound strongly. After all, competitors Ultratech, Shree Cement, Ramco, and others posted similar challenges, showing this is less about company specific issues and more a rough patch for the sector. For investors, the message is clear: patience and integration gains are key. Chapter 3: Green Energy, the crown jewel of annuity cash flows. Among Adani's many businesses, the green energy vertical stands apart as the engine turning rapid growth into predictable profit. FY25 marked a milestone. Installed capacity reached 11.6 gigawatts, up 40% year over year. Profits soared 108% and EBITDA margin hovered above 90%, exceptional in any energy sector. How does Adani achieve such stability in a nuancedly volatile sector? The secret lies in long-term PPAs, contracts locking in power prices and volumes for 15 to 25 years. Over 95% of revenue is backed by these arrangements, installing the business from market price swings. Yet some challenges persist. Land acquisition protests delayed certain projects. About 60% of solar modules historically came from China, raising concerns about tariff hikes or supply chain shocks. But Adani is aggressively addressing supply risks by loudly growing its domestic solar panel manufacturing capacity via Adani New Industries, part of the integrated group approach. The Khavda Solar Park in Gujarat exemplifies this new phase: massive capacity with domestic manufacturing securing supply and quality. For investors eyeing stable returns in infrastructure, Adani Green's annuity income model represents a new benchmark, a safe harbor in a sea of sector volatility. Chapter 4: Kerala's Vizhinjam Seaport, New Gateway to Asia and Africa. The operationalization of India's first deep-water transshipment hub at Vizhinjam, Kerala, is more than an infrastructure achievement. It's a strategic milestone reshaping trade routes. Finished after years of delay, the port boasts state-of-the-art facilities attracting world-class shipping like Maersk's, the capacity to handle the largest container vessels, challenging Dubai and Singapore's dominance, immediate revenue through port fees and logistic services, adding predictable annuity cash flows for Adani ports. India's location on the east-west global freight corridor positions Vizhinjam as a vital node. The port reduces transshipment costs, helps decongest Indian ports like Chennai and Kochi, and facilitates faster trade routes. For Adani, this project complements its diversified, cash-generative portfolio, boosting its strategic moat in infrastructure while strengthening financials with stable port revenues. The risks, rewards, and reality of India's biggest corporate gamble. Adani Group's FY25 journey is more than a comeback narrative. It's an unfolding experiment in managing vast debt amid India's drive to build world-class infrastructure. The debt remains high, the risks real, but so too is the group's growing base of annuity businesses delivering steady cash flows. The drama of meltdown turned reinvention has propelled the group onto a path few expected. Cement profits slowed, mirroring a tough sector. Green energy scaled fast, adding a shining beacon of recurring revenue. Ports like Vizhinjam symbolize India's rising infrastructure stature and offer financial predictability unseen before. The question remains: Has Adani truly transformed risk into strength? Or is it the tightrope still too thin to walk without a stumble? We invite you to weigh in with your views. Don't forget to subscribe and click the bell to catch our future updates, tracking the real story behind the numbers, the drama, and India's infrastructure revolution. Thank you for watching.